IVM.
BQ Big Decisions, the BloombergQuint podcast that helps you make the right financial choices. If you were a 90s kid, you'll probably have grown up hearing that bank fixed deposits and recurring deposits are the safest and best investments. It was a sign of the times. It's possible that either your parents or someone that they knew burnt their fingers in the stock market. In 2019, these deposits are still among the safest investments available. But are they still the best? I suppose it would depend on what you need them for. This is BQ Big Decisions and I'm Alex Matthew. Thanks so much for tuning in. Joining me now is Amol Joshi, the founder of Planrupee Investments. Thanks so much for joining me today, Amol.
Alex, pleasure to be here.
Amol, I think it's a very topical conversation to have.
Sure.
Deposits, bank deposits of all kinds. And the reason we're talking about this, of course, is because the equity markets, or rather the outlook for the equity markets, at least for the short term, is looking just a little jittery.
Right. Markets have been volatile in recent past, and obviously that has made people doubt about the future as well. And little bit of economic slowdown that you see about, yes, it's very topical, Alex.
And more experts are advising caution. You automatically think about the safe investments available out there.
Sure.
From the perspective of the advice that you give to your clients,
right,
where does fixed deposits or deposits in a bank rank?
Right. So, Alex, as we know, fixed deposit, the name itself gives you confidence that this is something fixed. There is a fixed tenure. You are going to get a fixed rate of interest on it. Fixed deposits are evergreen products. Most of the time, your first salary or your first check that you deposited, the earnings that you deposited, probably went into a saving account, and there is a good chance that you probably have had fixed deposits or RDs also. So these are definitely, as I said earlier, these are evergreen products, but the utility of fixed deposits will depend on what exactly are you trying to achieve. If that is utmost safety, if that is what you are trying to achieve, these products really are evergreen. They continue to be very, very fruitful for you as an investment instrument. If you have other avenues or other benefits in your mind, benefits, like tax efficiency or higher returns, then probably you will have to diversify from fixed deposits to other products as well.
You know, I'd like to talk about all the benefits involved in holding bank deposits. But before we do that, let's talk about the context. As we stand, there's a lot of people who've actually said over the last couple of months in the equity markets, it's been one step forward and two steps back.
Right.
So assume, and I'm giving you a hypothetical scenario here, you have a lot of individuals out there who have substantial funds that are lying idle in their savings bank accounts, which we'll get to in a bit. You shouldn't do that.
Right.
But if they've been thinking about putting money into the equity markets and they've been waiting for the right time, which again you shouldn't do, at this point, would you say that they should hold on and perhaps consider a bank deposit?
Right, Alex. So, see, if you have been first-time investor or investor who has recently kind of suffered the equity market volatility, and if your additional funds are in bank account, then I would say probably you should stay put. However, if you are a seasoned investor, there is a very good chance that you have not stayed into fixed deposits at all. There are comparable products, and I'm sure the flow of the conversation we will get to those products.
Right.
But I would say my brief answer to this is, if your existing funds are in savings account or a short-term fixed deposits, you can stay put in that instrument.
Okay, so from the perspective of safety, we've established that fixed deposits, recurring deposits, bank deposits as a whole
Yes.
are right up there. But if we're talking about the rates available, and this is again very topical because
Right.
just last week you had the Reserve Bank of India that cut rates again.
Sure.
So it is consecutive rate cuts. This time it was by 35 basis points. A long story short, in the recent times there have been cuts by over 1 percentage point. So
Correct.
the rates are coming down.
Yes.
And that makes deposits less attractive.
Yes, it certainly does. And you mentioned, let me also talk about nostalgic time, 90s kids. So probably all those 90s kids were very young, but people would remember that in early 90s fixed deposits or even PPF rates were in double digits, as high as 12 or 14%. From those levels, as the inflation has moderated, fixed deposit rates have been continuously falling from 12, 14 levels to 10 to 9 to 8 and currently sub 7 after the recent cuts, fixed deposit, if I'm not wrong, 1 year fixed deposit will yield you somewhere between 6.5 to 7%. There is very important point of taxation. Again, we will get to that probably in our flow of conversation. But if 6.5 to 7% or 6 to 7% is your target return before tax, pre-tax, then fixed deposits again would be a suitable product for you. But if you really give it a thought as to what is the kind of inflation experience you are having, as well as what is the lifestyle creep, in the sense enhancement in your lifestyle, your inflation experience is probably higher. And again, there would be a small question mark as to whether fixed deposits are really right products for you to invest in.
Okay, now I think this is the perfect point in the conversation to jump to financial planning theory.
Right.
And I want to understand from you in terms of the scale or the spectrum of instruments that are available to put money in.
Right.
You wouldn't really rank deposits up there in terms of wealth creation, in terms of growing your capital. So what really are the purposes that you can employ deposits for?
Right. So, Alex, you employ deposits. If you are absolutely a fresh, novice, new investor, then you employ deposits to first of all get you higher returns than saving account. As you know, most of the banks, larger ones, your saving account rate of interest is 3.5%.
Right.
3.5% just doesn't cut it. We all know that. All the listeners would know about it too. Instead of 3.5, if you want to go at a higher rate of earnings from your money, then you should look at fixed deposits. That's number one, first purpose. Second one is, if you are looking funds just as a temporary deployment, you want to use your funds 6 months down the line for a vacation, 2 months down the line for your child's fees payment or something like that, then also fixed deposits probably are good instruments. But Alex, let me again touch upon something what you said, wealth creation.
Right.
Fixed deposits, I'm very certain in my mind, are not an instrument for wealth creation.
Especially because the rates are as
Especially because wealth creation. So now let's wealth creation would differ for each investor, each individual. Quickly, what does wealth creation mean for me? So for me, wealth creation is you should be able to beat inflation, number one, beat inflation on a post-tax basis, number two, and beat inflation on a post-tax basis and then get some return over and above it. That's my definition of wealth creation. Now, if you have a fixed deposit rate of 6 to 7%, if you happen to be in a 20 to 30% tax bracket, you are not post-tax, on a post-tax basis, you are not going to get more than 5.5%.
Right.
Now, when your inflation itself is about at these levels, you are not really making any money by investing in fixed deposits, and hence my answer to what question you asked is, fixed deposit, please use it for short-term fund parking. Please use it if you are an absolutely new investor yet to meet an advisor, planner, yet to know about other financial products. But as soon as you make a beginning, there are better products. Those are tax efficient and probably having better return available for you.
Okay, now I do want to talk about the various types of deposits very quickly, and most people are familiar with the available options. There's the savings and current account deposits, which banks fondly call CASA. They like it so much that they've given it a nickname. Then there are also fixed deposits and recurring deposits, which we've spoken about briefly. And then there's something called a flexi fixed deposit. I must admit that I haven't read too much about this. Do you want to talk about it a little bit?
Sure, Alex. So flexi fixed deposit, some banks have a different name called that sweep in, sweep out. The basic idea is you give a minimum benchmark of amount that stays in your saving account. Let's say 1 lakh rupees. Any moment on end of the day, if your account balance is in excess of 1 lakh rupees, let's say for a moment 2 lakh rupees, then excess amount of 1 lakh. 1 lakh is minimum in saving account, 1 lakh excess amount gets automatically converted to a 1 year fixed deposit, where you earn higher return than saving account. That's the simplest explanation of sweep in, sweep out deposit or a flexi fixed deposit.
But there is no penalty that is levied, because I understand in a fixed deposit, a normal fixed deposit, if you break it before the term is completed, there is a penalty on
there is something called as premature withdrawal penalty. But in flexi fixed deposit, since the idea is enhancing investors or customers' return, there is no penalty if you happen to withdraw the excess amount prematurely. However, you will not get 1 year FD rate, which is always higher than a lower bracket. Suppose you happen to redeem your amount or redeem your excess amount deposit, let's say in 6 months period of time. And over a 6 month period, if the rate of interest is 5%, then instead of 1 year 6.5, you will get 5% for the excess amount that you have withdrawn.
Understood. Okay, now I briefly did mention about CASA, which is a savings account and current account.
Yes.
And the reason why banks like it so much is because they don't have to pay too much interest on it, which is not good from the perspective of the person who's holding those deposits. Right?
That's correct. You also alluded to financial planning in between earlier few minutes back. One of the basic principle of financial planning is, since saving account yields you 3.5%, other than your emergency funds, other than the money that you are going to need immediately in few days, do not leave excess amount in your savings bank account.
So when you say don't leave excess, Amol, as a thumb rule, what would you say is the amount of money that you should generally keep, and not more than that?
Yes. Since you mentioned thumb rule, the financial planning basics teach us that you should have not more than 3 to 6 months of your monthly expenses.
Okay.
If you spend 30,000 rupees a month, then something like 90,000 to 1.8 lakh, meaning 1 lakh to 2 lakh is the amount that you should hold in your bank account.
If your expenses are 30,000.
If your expenses are 30,000, that's correct.
Fair enough. Okay, now we should also talk about the tax angle, right? Because
Yes.
you briefly talked about tax and the fact that fixed deposits don't rank very highly in terms of post-tax return.
Sure.
So how do we understand the tax on interest that you earn from deposits?
Okay, so it's very simple to understand again. The interest that you generate from fixed deposits gets added to your total income, and hence it gets taxed at the rate of marginal tax slab for you. So
Okay.
this is slightly technical, although I was able to fit it into one line. But even simpler explanation is, fixed deposit interest will be taxed at your tax bracket.
So
if
that's
you are
all deposit interest?
that is all deposit interest. I'm talking about fixed deposit. Saving account deposit, interest generated out of saving account has some exemption to it. But currently we are talking about fixed deposits.
deposits,
So for fixed deposits, if you are into 10% tax bracket, then you will pay 10% tax on the interest that you generate. If you are in a 30% tax bracket, you will pay 30%.
Okay. And if you're talking about the interest that you earn from all deposits, how do you
In
break that
savings
up?
account for a non-senior citizen, interest earned per annum up to 10,000 rupees is tax free.
Right.
So in suppose if I had to assume that your saving account yields you 4%, then deposit that you keep in saving account up to 2.5 lakh rupees is tax free. Why? 4% of 2.5 lakh is 10,000 and 10,000 is tax free. But again, it's not very prudent to keep such an high amount, because although it is tax free, your return is still 3.5 or 4%.
Correct. And for
And
senior
that's not what you
citizens, there's a higher amount.
Yes.
That's 50,000 rupees.
That's correct.
Okay. All right. So we've talked about the tax aspect of it. What are the alternatives? Let's talk about the alternatives now. Fixed deposits, like we mentioned at the start, is a safe investment, and that's why people gravitate towards it. But there are other options available in debt securities.
That's correct. So, Alex, there are various other debt securities or debt products. Many of them are offered by government entities. I can name PPF, I can name postal deposits. But if I club all of them with fixed deposits, because tax efficiency for all the products other than PPF, it's something, tax efficiency is missing. If I had to straight away come to capital market, then debt fund, it's something that comes closest to the fixed deposits. I'm not trying to say all debt funds, because there are various debt fund categories, but I would say something like liquid fund is something that comes closest to the fixed deposit, and it has couple of advantages as well. In fixed deposits, let's take 1 year fixed deposit example. There is a premature withdrawal penalty if you exit before 1 year.
Right.
In liquid funds, you can exit in 1 day, 1 week or 1 month. There is simply no premature withdrawal penalty or no exit load. So liquid fund is something that comes closest to a replacement from capital market to a fixed deposit product.
And it's also the first step that you would take to become a more a savvy investor.
That is
shall we
correct.
say.
Liquid fund should be your stepping stone into capital markets.
Fantastic. Okay. Apart from liquid funds, do you want to name any others?
I would say once you experience liquid funds, and assuming that you are still a beginner, still learning the ropes of mutual fund or fixed income investing, I would say that if you have a 3-year sort of a horizon, then ultra short-term funds, or even better, banking and PSU debt fund. This is the category that you should keenly look at.
But there are risks involved in these debt funds, and we've heard about recent occurrences where there has been side pocketing. Let's not get into the details of that, but
that's correct.
There is a little risk involved here.
In mutual funds, as mutual funds always, all the advertisements of mutual funds will always say that subject to market risk. Even debt market or debt instruments are subject to some risks. But as I said, if you start from liquid fund, get an experience of how the fund behaves. And I'm sure that your experience is going to be very close to fixed deposits, if not better, considering the no exit load sort of other advantages. And then if you go to subsequent categories, by knowing the risk as well as the potential rewards. So mutual funds do not just have risk. They have rewards like tax efficiency. They have rewards like potential for higher return generation. Once you understand this, then I think you will be comfortable to see the volatility and still stay put to get those benefits.
I was going to ask you about the tax efficiency. It is clearly more tax efficient because of indexation benefits also.
Yes, if you stay invested for more than 3 years, there is a clear-cut benefit called as indexation benefit. Can I give you a quick example? Suppose your debt fund earns you 7% return. You have been investing for 3 years in that product. Within those 3-year period, if the inflation has been 5%, then on 7% capital gain, the interest is charged on post-inflation interest only,
which
or
is 2%.
Post-inflation capital gains only. Sorry, interest is not right word in mutual funds. Capital gain is the right word, which is 2%, as you rightly identified. On this 2%, flat 20% tax is charged, which is nothing but post-indexation. Tax bracket is flat 20%. So this is hugely tax efficient. If I had to give you an example also, 20% of 2% is 0.40%. So 7 minus 0.40, your return will be 6.60% post-tax, which again is substantially higher compared to FD of 5.5% post-tax.
Especially if you're in the higher tax bracket.
Especially if you are in a higher tax bracket, yes.
Okay, so Amol, the bottom line, and we're coming to the end of the conversation here, you're not going to have any major capital appreciation from a bank deposit.
That's correct.
I think that,
especially on a post-tax basis.
Yes. So what would your advice be finally to our listeners?
I would repeat what I said earlier. If you are a beginner investor, if you are yet to get a proper your own study and understanding of capital markets, or if you do not have an advisor, then use fixed deposits and saving account as your temporary funds parking avenue or instrument. Get a good advisor, or try to learn about the products, various other tax benefits, all the products that we discussed in this last few minutes, and then use fixed deposits as a stepping stone to graduate to those products where you have a chance of earning higher return as well as chance of saving on tax component.
I think this is very, or it resonates very well with an earlier conversation that we had on BQ Big Decisions, which is the first steps that you need to take in your financial journey. And the advice that financial planner had given was that you need to understand how you spend. So perhaps in the first few months of an investor trying to understand how much they spend and where they spend, they could use these bank deposits as you suggest.
Yes.
But it's been a fantastic conversation, Amol. Thank you so much for joining me today and really taking us through the ropes on bank deposits.
Thanks for having me for the show, Alex. Thank you.
Well, dear listener, it's been a great conversation and I hope it helped you out. Do let us know what you think on any one of our social media platforms, and do stay tuned. There's a lot more coming up in this space. This was BQ Big Decisions on BloombergQuint.
If you enjoyed Big Decisions, check out some other podcasts on the IVM Podcast Network. You can check out Paisa Vaisa, hosted by Anupam Gupta, Advertising is Dead, hosted by Varun Dugirala, the Ronnie Screwwala podcast, hosted by Ronnie Screwwala, or Cyrus Says, hosted by Cyrus Procha. These shows are available on the IVM Podcast website, app, or wherever you get your podcasts from.
Hello everyone, I'm Zain.
I'm Avanti.
And welcome back to a brand new season of Marbles Lost and Found.
A show on mental health and its stigma, and we're kind of making it an open conversation.
Pretty much, yeah. And we're really, really excited about this season because we have a number of guests on and we'll be talking about things like addiction,
grief, children and mental health.
Exactly, children and mental health. And our listeners have also written in
this
time. Yes,
and we have an episode dedicated to that.
Yes, and guys, thank you so much for writing, and we really, really appreciate it.
And we're really excited for you to tune in on Tuesdays on the IVM website or app or wherever you get your podcasts from.
And you can find Marbles Lost and Found on Facebook, or you can find Marbles Lost and Found on Instagram as well, the handle being Marbles Podcast India.
Can't wait for you to tune in.
Thank you very much. See you guys soon.
Are you constantly seeking happiness? Wondering how to make the most of every day? How not to let your inhibitions stop you from achieving your goals? It's now time to get your A-game on. It's time to unlock your true potential. Tune in to the Empowering series with me, Zarina Poonawalla, to feel empowered in all genres of life. From behavioral skills to management skills, from health to relationships, from mental well-being to emotional well-being, and of course your finances. I've got you covered. With these tips and tricks from me, Zarina, and true life stories from my amazing guests, you're bound to bring your purest to the table. Tune in to the Empowering series with Zarina Poonawalla every Thursday on the IVM Podcast app, website, or wherever you listen to podcasts.